Today we are going to do financial market part 3. Now what are we going to study? We will study the concept of capital market, the difference between the primary and the secondary market, and we'll also do the difference between capital market and the money market and the method of floating new securities in the primary market. Now what is the capital market? We have already studied the financial market. Financial market has got two parts, money market and the capital market. Money market is for the short term and capital market is for the long term. So when the business houses want to raise finance for a long term, medium or long term, then they go to the capital market. So capital market is for the medium and long term funds, and both debt and equity can be raised here. That means equity, preference and debentures. And what constitutes this market? We have the commercial banks and the stock exchange. Stock exchange is also called the secondary market. And this market has been set up so that the firms are able to raise funds at a reasonable cost. And this market directly leads to capital formation that we will be studying later on also. An investment in this market from the investor's point of view is not very huge. Now let us do the difference between the capital market and the money market. As I've told you earlier, money market is for the short term. Now who are the participants? Generally the participants are the same, the bank, etc. But two main things are there. First, RBI is very actively involved in money market because RBI issues treasury bill. And in the capital market, we have individual members also who interact in the stock exchange, whereas their participation in money market is much less. Then the instruments traded in the capital market, you can buy and sell equity shares, preference shares, debentures, etc. Whereas in the money market, we have the treasury bill, the commercial paper, all these instruments are traded. Then the investment outlay in case of capital market is much less. For example, you want to buy a share, you may get it for even 100 rupees. But in the money market, the investment outlay is much more. Like for example, treasury bill minimum is 25,000. Now duration, capital markets for medium and long term. Now children remember long term, but they forget medium. So capital market is for medium and long term, whereas money market is for short term. Then less degree of liquidity because you're holding the securities for a longer time. And in money market, you get your money back within 1 year. So there's high degree of liquidity. Liquidity means it being converted into cash. Now safety, money market is very safe. Why? Because RBI is involved there. And as compared to the money market, capital market is not that safe. Though capital market is also safe, but when we compare it to the money market, it's riskier. Then what about the expected return? You expect more return in capital market because you're investing the funds for a longer time and you're taking more risk. So the yield expected in capital market is much more than that of the money market. Now let us study the capital market. Now capital market has got two parts, primary market and secondary market. Primary market is that market where the companies directly sell their securities. So when you are buying securities and you're buying directly from the company or company is issuing for the first time, then they sell it in the primary market. Now suppose somebody has purchased these securities. Now they don't want to keep it, they want to sell it. So they can sell it in the secondary market. Secondary market is also called the stock exchange. Just like secondary market for books, for furniture, similarly for buying and selling of securities also. So let's start with the primary market. A primary market is that market where the companies, they sell their shares for the first time. So when the company wants to raise finance, directly they sell their shares in the primary market. So it's also called new issue market. And here the securities are being sold for the first time. And here again, because it's a part of the financial market only, so we have banks and mutual funds and even individuals. You can also go directly buy shares of the company, shares, debentures, any security of the company. And the securities traded are equity shares, preference shares, debentures, loans, deposit, etc. And it has no fixed geographical location. Primary market has no fixed geographical location. These are the features of the primary market. Now, the securities that are traded in the primary market, they're 5 methods of flotation or raising capital: offer through prospectus, offer for sale, private placement, rights issue, and EIPO. So let's start with the first one, offer through prospectus. Now, if you are in the habit of reading the newspaper, you would have come across these advertisements issued by the company regarding their shares or debentures or any security that they want to sell to the public. In accountancy also, we have the chapter on shares. In that, the same thing is done. So when the company wants to sell some shares or securities to the public, then they take out an advertisement in the newspaper or in magazines and give a time limit to the people to buy the shares. This is called offer through prospectus. And this is most popular and the oldest form of raising capital through the primary market. So it's the most popular method, and public is invited through the issue of prospectus. And a direct appeal is made to the public to buy shares. So the balance sheet might be put up there, and whatever the company is doing, everything about the company might be mentioned so that people are motivated to buy shares in that company. Then if suppose the people don't buy the shares, the required amount of money you're not able to raise, then they're underwriters. Underwriters are those people who buy the shares so that the company can be started, that project can be started. So this is called underwriters, and these shares have to be listed in some stock exchange, because suppose you buy shares of a company and then subsequently you don't want to hold it, then there should be some place where you should be able to sell it. So each and every new issue of the company has to be listed with some stock exchange, and whatever is written in the prospectus has to be according to guidelines of SEBI and Companies Act. Otherwise it's considered to be a very big mistake or misappropriation if it is not according to those terms. Then come to offer for sale. Now let us say a company needs 100 crores. Now that's not a very big amount for a big company. So they need a small amount of 100 crores. Now what they do is they get hold of some intermediaries, brokers, and they sell it en bloc to them. They don't go to the public, because going to the public is a long process. So you have to first take out an advertisement and then wait for them to buy the shares. Some people may pay the application money and not pay the allotment money. So it's a long process. And the flotation cost is also very high. So what the company does is they sell these shares en bloc. En bloc means lump sum to the intermediaries or the brokers. Now the brokers buy it. Suppose the company needs 100 crores. So the brokers buy full 100 crores from the company in one go. So the company gets the entire amount of money. And then these brokers keep on holding it, and then they sell it to the public as and when the price goes up. So this is the second method of raising funds directly from the public by the company. So securities are sold through the intermediaries, and it is not sold directly to the public. And these intermediaries can be issuing houses or stockbrokers. And the securities are sold in lump sum, that is en bloc. And these intermediaries, they subsequently sell it to the public. So if they bought these shares for ₹100 and then the price of the share goes up to 120, then these intermediaries sell it to the public for 120. So they make their profit there. So remember, if the question says the securities are sold to the intermediaries or en bloc, that means it is offer for sale. Then comes private placement. Now let us say the company needs only 20 crores. So they have their own people who want to invest. So they sell it to some selected individuals or institutional investors whose work is only to buy shares of these companies as and when the company needs it. So they buy these, the company sells their shares to these individuals. Now this way they're able to raise the capital very quickly. Suppose I need money and I call up somebody whom I know, and that person gives me, by evening I get my money. So it is very quickly. Plus, raising finance through the primary market sometimes is very expensive. So for small companies, it's a little difficult. So private placement is a very good method for those who don't want to spend money on public issue. Flotation cost itself sometimes is quite big. And these shares people might not even buy it. So they just place it directly to some people who are known to them. So this is called private placement. So privately the shares are placed. So the company sell it to some selected individuals or institutional investors. And here the money is raised very quickly. And then those companies who cannot afford a public issue, because public issue is expensive, you have to do all the formalities. And those companies who find it expensive, and because of the various rules and regulations of the primary market, for them this is the best method. So if the company wants to cut costs on issue of securities, then private placement is a good idea. Then comes rights issue. As the name suggests, right, the equity shareholders, who are the actual owners of the company, they have a right over the new issue. If more equity shares are being issued, then their right is diluted. Suppose, let's take a hypothetical example, there are 100 equity shareholders. Now more equity shares are to be issued and another 100 equity shares are being issued. So the right of the existing equity shareholders goes down to 50%. So the law says that the existing equity shareholders have a right to the new issue. So if they want to subscribe to the new issue, well and good. Otherwise, it goes on to the public. Now, these existing equity shareholders can subscribe to the new issue in the ratio in which they're holding the shares. And this is also called preemptive issue. You empty it out to the equity shareholders before you issue to the public. So this is a privilege given to the existing shareholders. And they can buy the shares in the new shares in the proportion in which they're holding the original shares. Suppose the equity shareholder is holding 10 shares and now 50% more capital is to be raised. So this equity shareholder can buy 5 more shares. If he wants to buy more, then later on he can buy it from the stock market. And it is compulsory for the existing companies. Otherwise, those people who founded the company initially, their right is at stake. Then comes EIPO. This is the latest, currently it is doing. Suppose you want to watch a movie in the theater. So nowadays, nobody goes and books the ticket in advance. They stand in long lines. Nobody does that. Very rarely do you ever do that. So you book it through your mobile, through the internet. Similarly, the company sells their shares through the internet, and people also buy it through the internet. All the trading procedure nowadays is done through the internet. So it is called initial public offer, electronically it is sold. IPO is initial public offer, and it is an online method of selling. So you don't even have to go anywhere. Only through your computer you can buy and sell. And SEBI has appointed registers particularly for this purpose. Now the company has to apply for listing of securities also. You cannot sell it from any other stock exchange where you have listed earlier. You have to get your securities listed in a stock exchange, and you have to appoint a register also. The company appoints a register so that they have electronic connectivity. And lead managers, they coordinate all the activities so that nothing goes wrong, so that such a situation does not arise that a particular batch of shares are issued to 2 people separately. So to manage all that, lead managers are there. So that brings us to the difference between the primary market and the secondary market. So primary market is the new issue market where the shares are issued for the first time, and secondary market, as you know, stock exchange where the shares which have already been issued can be resold. So let's study it. Primary market is for the new issue and secondary market is for the existing securities. Then the scope is that these are sold directly to the investors, whereas in the secondary market it is exchange between the investors. So somebody who wants to buy will contact somebody who wants to sell, and between these investors they will exchange the securities. Then primary market leads to capital formation directly, but secondary market also leads to capital formation but indirectly. And the nature in the primary market, it's only buying. People only buy. You cannot sell back the shares to the company. These days, buyback of shares has started, but not to a large extent. So only buying takes place, whereas in the secondary market, both buying and selling takes place. Then come to price determination. Now in the primary market, the price of the security is decided by the management, by the board of directors, at what price do they want to sell. And in the secondary market, the price of the security is decided by the forces of demand and supply. Now location, primary market has no fixed geographical location, whereas secondary market is located at specific places. Like we have BSc in Bombay. So that brings us to the case study. Now first we'll see what is asked and then we will read the case study. Name the method through which the company decided to raise additional capital. Remember the 5 methods. So let us see which method are they talking about here. Sikka Limited, a reputed industrial machines manufacturer, needs a lot of money as additional capital to expand the business. Mr. Amit Joshi, the chief executive officer of the company, wants to raise funds through equity. Okay. The finance manager, Mr. Narinder Singh, suggested that the shares may be sold to investing public through intermediaries as the same will be less expensive. Name the method through which the company decided to raise additional capital. I'm sure you found the answer, but I'll give you a moment to recollect. Yes, you got it right. Through intermediaries. And what is that? It is offer for sale. Got it? This is the method of doing case studies. So that's all in this lecture. Thank you.